Welcome to today's deep dive. I'm your host, and I'm honestly just so thrilled you're joining us today.
And I'm your resident tech and finance expert. We have a really fascinating situation to look at today.
We really do. I've just finished digesting this massive stack of recent financial data.
It's a lot to get through.
It is, but I can't wait to share it with you, the listener, because the picture we're seeing on Microsoft today is incredibly complex.
Right. They're the bedrock of modern computing, but they're at this really tense crossroads right now.
Exactly. So let's set the stage. Today is March 11th, 2026. We're looking closely at Microsoft ticker symbol MSFT.
And as of this afternoon, the stock is hovering right around $404 to $405.
Yeah, which means it's actually down about 14.2% year to date.
Which is a significant dip.
Right. So our core mission for you today is figuring this out. Is this $3 trillion giant a good investment today? Or is it a risky bet just sort of hiding behind a premium valuation?
To answer that, we really have to look past the daily stock price and dig into the actual structural health of the business.
And we've got an amazing stack of sources to help us do exactly that. We're looking at their fiscal year 2026 Q1 and Q2 earnings releases.
As well as their official 10Q filing.
Yep. Plus stock market forecasts from Zacks, Public.com, Trefis, and various Wall Street analysts.
And we're balancing all those numbers with tech reports from GeekWire, No Jitter, and NASDAQ.
Okay, let's unpack this. I want to start with the sheer scale of their recent earnings because the top line numbers are they're almost hard to wrap your head around.
They really are staggering. For fiscal 2026 Q2, total revenue was a massive $81.3 billion.
Wow.
Yeah, that's up 17% year over year. But the real milestone, the one that defines this current era for them, is the cloud division.
Microsoft Cloud.
Exactly. For the first time ever, it crossed the $50 billion mark in a single quarter.
51.5 billion, right?
$51.5 billion in 3 months.
That is just wild. But we have to look at what's driving that consumption, and a huge part of it is artificial intelligence, specifically Microsoft 365 Copilot.
Yes, the No Jitter report highlights this perfectly. Copilot just hit 15 million paid seats.
15 million. And if you do the math on that, with those plans costing between $21 and $30 per user per month.
That is a highly lucrative recurring revenue stream.
It's massive. But the thing is, it currently only represents about 3.3% of their total commercial seats. They have 450 million commercial seats total.
What's fascinating here is how that 3.3% leaves this completely massive runway for growth. It connects directly to Microsoft's moat.
Right?
If you look at the commercial remaining performance obligation, or RPO, in their 10Q, it's skyrocketed by 110% to $625 billion.
$625 billion of RPO. Just to clarify for everyone listening, that basically means Microsoft has massive revenue visibility locked in, right? It's money their enterprise customers are legally obligated to pay them over time.
Precisely. It's guaranteed future revenue. It makes their economic moat incredibly deep.
Okay, so that's the blockbuster side of things. But there are cracks in the armor. It's not all perfect.
Far from it.
Let's pivot to the weak spots. Starting with Xbox. Revenue there was officially below expectations.
Right. Hardware plunged 32%.
32%, and content and services dropped 5%.
Though NASDAQ did report they're developing a next-gen console codenamed Project Helix to try and bounce back.
Yeah, we'll see how that goes. But gaming wasn't the only issue. LinkedIn hit a record $5 billion in quarterly revenue thanks to that new TikTok-style video pivot.
Highly successful pivot for engagement, yes.
But if you read the footnotes, and this is why we read the footnotes, there's a contested 310 million euro fine from Ireland.
Which is about $335 million US dollars.
Right, a GDPR fine regarding targeted advertising and user consent.
It highlights the regulatory friction they face as they scale these data-driven platforms.
Absolutely, but honestly, a $335 million fine is a drop in the bucket compared to their expenses. Because here's where it gets really interesting.
The capital expenditures.
The CapEx. This is the elephant in the room. This is the metric terrifying investors right now. Capital expenditures surged 66% year over year.
Up to $37.5 billion.
In a single quarter.
If we connect this to the bigger picture, this is the AI CapEx overhang. They are pouring tens of billions into AI infrastructure, servers, land, cooling, chips.
And because of that spending, free cash flow actually fell 9.3% to $5.9 billion.
And cloud gross margin slipped from 70% down to 67%.
Which makes the market incredibly anxious. Investors are looking at that $37.5 billion and asking, When do we get a return on this investment?
Exactly. This anxiety is a primary reason the stock is down over 14% this year. And it's deeply tied to their exposure to OpenAI.
Yes. Let's talk about the OpenAI double-edged sword, because there's this weird accounting quirk in the Q2 release.
The GAAP versus non-GAAP numbers.
Right. JAP net income was up a massive 60% to 38.5 billion. Sounds amazing. But non-GAAP was only up 23% to 30.9 billion.
Because they had to back out a $7.6 billion net gain from their OpenAI investments.
It's just a paper gain. It's not operational cash. And it highlights this single customer concentration risk.
Which is severe. Remember, market jitters about Microsoft's reliance on OpenAI previously wiped out $360 billion of market cap in a single trading session.
One session. And beyond partner risk, they also have massive geopolitical risks with this infrastructure build-out.
Yes, our sources include a CNBC report noting how the Iran war could impact hyperscalers trying to build massive AI data centers in the Middle East.
And we want to be very clear with you listening, we are not taking any political sides here. We're impartially reporting what the financial sources are saying.
Absolutely. We're strictly looking at the economic reality. Global instability threatens supply chains and energy grids needed for these physical data centers.
Microsoft even explicitly cites catastrophic events or geopolitical conditions as major execution risks in their forward-looking statements.
It's a very real logistical threat to that $37.5 billion CapEx spend.
So with all that spending and risk, let's look at the competitive landscape. The cloud wars. Where do they stand against Amazon and Google?
According to the sources, Amazon leads global cloud with 28%.
Microsoft is second with 21%.
Google is at 14%, and Oracle trails at 3%.
So 21% is very solid. And Wall Street analysts are surprisingly bullish despite the CapEx fears.
Very bullish. Public.com tracks 31 Wall Street analysts for MSFT.
And out of 31 analysts, there isn't a single sell rating, 0.
39% say strong buy.
55% say buy.
And 6% say hold.
The consensus 12-month price target is $595.90. That is roughly a 47% upside from today's price.
Morgan Stanley and RBC Capital are even predicting it hits $640 to $650.
Which is just staggering optimism.
But we have to provide the counterweight here. Zacks rates the stock a hold.
And they gave it a value score of D, right?
Yes, a D. Because Microsoft is trading at a premium price-to-sales ratio of 8.38 times.
While the software industry average is only 7.02 times?
Exactly. The bears are warning about overly optimistic earnings expectations for fiscal 26 and 27.
Because if enterprise AI adoption is slower than expected and those margin headwinds from the server buildouts keep up,
you're paying a massive premium for delayed growth.
Right. Although, if you're an income-focused investor, they are still returning capital. They returned $12.7 billion to shareholders in Q2.
The dividend is very safe, albeit small. $3.64 annually.
Which is a 0.90% yield. The payout ratio is just 21.78%, so they're retaining most of their cash for AI. But they do have 20 years of consecutive dividend growth.
A testament to their long-term stability.
So what does this all mean?
It's the ultimate tug-of-war.
It really is. I mean, historically, this stock lost 65% in the dot-com crash and 58% in the financial crisis. It's not immune to gravity.
No, but today they have an incredible $625 billion in locked-in future revenue.
So let's bring it back to you, the listener. If you're looking to invest today, you are caught right between a rock and a hard place.
You have a stock down 14% year-to-date because of very real fears of out-of-control AI spending.
Versus a chorus of Wall Street analysts screaming that it's going to hit nearly $600 a share.
It really comes down to whether you believe the AI build-out will generate fast enough returns to justify that premium 8.38 price-to-sales ratio.
Exactly.
But before we wrap up, I want to leave everyone with a thought experiment. Something that builds on the sources, but introduces a totally new paradigm.
Ooh, I love these. What are you thinking?
We've been measuring Copilot success by paid human seats, right?
All right.
3 million so far.
Right, one human, one license.
But the sources note that Microsoft Copilot Studio allows companies to build independent AI agents.
Okay.
What happens to the business model when these AI agents become autonomous entities? When they start consuming cloud compute and making purchasing decisions on their own? 227.
Oh, wow. So not even human users anymore.
Exactly. Could the next massive revenue driver for Azure be non-human customers. It would fundamentally alter how we calculate user metrics and CapEx return on investment.
That is a brilliant point. If non-human agents are just continuously burning through Azure Compute, that entirely changes the ceiling for their revenue.
It changes the entire math of the cloud.
That is definitely something for all of you to mull over. Thank you so much for joining us on this deep dive today. We really hope this helped you map out the complexities of Microsoft's current landscape. Keep questioning the data, keep looking at the horizon, and we will catch you next time.